Hello and welcome back to Know Where to Invest. I'm Robert Sadler and I'm the founder of Know Where to Invest, and this is video number 6 in a series of videos in which I tackle the challenges of investing during a crisis. And as you will know from my earlier videos, in my opinion, it doesn't matter whether it's a crisis or everything's going well. You should always follow a consistent investment framework. Now, today, the question I want to tackle or address is why your real estate investment is not a passive investment and is not generating passive income. Now, I hear this an awful lot. I see this on Twitter, Facebook, where people think that their real estate investment is passive, and today I'm going to explain to you why it isn't. And so by the end of this video, you will know where to find actual passive investments that can generate a passive income for you. Now, I was talking to a friend of mine recently, and he's very keen to generate a passive income, and the reason for that is that he's a family man. He'd like to spend more time with his family, but he doesn't know where to look to find these investments. And one of the things he's tried, or at least he's doing at the moment, is that he has an awful lot of excess money sitting in savings accounts. So he's one of these responsible and disciplined people who lives within his means and doesn't spend more than he earns, and it's a good problem to have, but the problem he has is that this money is building up in savings accounts. And if you've seen my earlier videos or you've read my blog, then you'll understand that we don't want to have too much money sat in savings accounts, because savings accounts basically pay you negative interest. In other words, you're losing money by keeping your money in a savings account. Now, that's okay if you need some money on hand to deal with emergencies, but when you have in mind a goal to retire or at least earn a significant passive income in 10-20 years time, it's going to be a lot harder for you to do that by keeping your money in savings accounts. Now, the other option he's looked at is buying gold. Now, gold, I think, is a great asset, and I think it's a great asset to have in an on-hand portfolio for emergencies. It holds its value really, really well. And in fact, if we look at charts or the history of the price of gold, you see that it's gone up continuously over time. And this is because of inflation and the fact that over time our currencies lose their value. So gold is an ideal investment for that reason. But of course, a block of gold doesn't generate any income. Gold is a commodity. And if you're looking for a passive income, gold's probably not necessarily ideal for that, although it's possible that you could sell portions of gold and generate income that way. But what we're looking at here is a passive income, not an income that requires you to trade your assets. Now, what investments actually do provide passive income? Typically funds. So there is a sort of a divide between what's active and what's passive. A passive investment is one where you make the initial investment decision, you put your money in a fund, and then you can sit back and let it work. You don't have to worry about it. I mean, I always recommend that you check it out at least once a year and make sure things are moving as expected and that you're moving in line with your goals and your investment strategy. But otherwise, you don't have to spend too much time on it. Now, an active investment requires you to take active control of that investment. You are entirely responsible for the performance of that investment. So if it's buying stocks, if you have a small trading portfolio, which I know a lot of people like to have, you're going to be looking at that portfolio probably every day and deciding whether to sell certain stocks and buy other stocks. You're also going to have to get to know those companies very well. You're going to have to read the annual report. You're going to have to get to know the management team, at least, from what you can find out about them. You're going to want to know about the sector, the industry, the products, all these sorts of things, if you're going to have an active portfolio and do some active investment. So you can already see how this could take up an awful lot of your time, and clearly and obviously is not passive. Whereas, as I said, with the fund, with or any similar type of investment, you can sort of sit back, relax, and not even think about it for most of the time. So, as I said, what investments do provide passive income as opposed to the active style? Well, funds based on indexes, so index funds. So one of the most famous index funds is the S&P 500. It's a very popular fund, but there are many other indices that can be invested in. And what you will find is that there are companies, investment companies out there that create funds that track these indices, and you can buy into those funds, and those funds will always have the same stocks as are in, for example, the S&P 500. So, and the S&P 500 typically or historically earns about 10% a year, and you can take a reasonable amount of confidence that will continue unless something happens to all of the stocks in America. And companies that provide these funds, and of course I'm not recommending any of these companies, just for examples, Vanguard, Fidelity, SCHWAB. If you go to these websites, you can open up an account and you can invest in the particular fund that you're interested in. Another option, there are real estate funds if you're very interested in real estate. There are bond funds, or you can go for bonds directly. So bonds are one of the most income-heavy investments there are, because you buy a bond, and let's say it's a US treasury, you give them, I don't know, depending on the denomination, but let's say it's 100,000 US dollars, and they will pay you a coupon payment every 6 months. Again, this depends on the bond. So, but that would be income, pure income coming straight to you. And is it passive? Is it not? It depends. If you're going to buy a lot of bonds, then you're probably moving more into the sort of the active side of things, as I described with stocks. But you could buy into a bond fund, a passive bond fund, and the same thing will result there. You'll get an annual return, which is probably made up mostly of income, but there is some value increases there, and the reason for that, just quickly, is that depending on what market interest rates are doing, and depending on what the coupon rate is on the bond, then the value of the bond can go up or down depending. So there is an element of risk there, but this is the reason for having a diversified bond portfolio. But getting back to real estate, why isn't your real estate investment passive? Well, before I get into that, if you're finding this information useful, please do go ahead and subscribe. Hit the bell next to the subscribe button so you get notified when the next video comes out, and please go ahead and like and even share the video. And if you need more information, as I've said before in previous videos, I am providing a free book on investment that you can get by clicking on the link in the description, and also there is I am offering a free email course which is customized to your unique investment challenges. So back to real estate. So typically when people think of real estate investments, they are imagining that they're going to buy an actual property, and this might be a residential property, it might be retail, it might be commercial, or it might be a mixture of them. And if it's residential, it might be a number of houses, or maybe it's multifamily units, or something in between. Now, if you are going to go that route, if you're going to buy properties, well, you're immediately making active decisions, because you have to decide which properties to buy, and you've got to look at what's going on in the market, in that local market, and also the overall economy. That's going to impact the value of the property. And people always assume the value of real estate will go up. It's not necessarily true, because in order to ensure that the value of your property goes up relative to others, you're going to have to do continual maintenance, upkeep, upgrading kitchens, bathrooms, these sorts of things. And then, of course, there's also picking a tenant. You're going to have to decide who you let your property to and who goes in there. Now, I know some people will say, well, I can hire a letting agent, I can hire a property manager to manage the property. Yes, you can, but you still have to make a decision about which letting agent, which property manager. How do you know a good one from a bad one? If you're not an expert in real estate, you may not know the answer to these questions. You might pick the wrong people. I've certainly seen this happen, and I'll give you an example of that in a minute. But there are other things that you're responsible for. If you are going to use a loan to buy the property, you have to arrange financing. You've got to decide which bank, which mortgage are you going to go with. And then it's not over once you've got the money. The bank will expect certain obligations to be placed upon you, certain duties that you will have under the loan agreement that you have with the bank. They will want you to provide them with periodic information on how the property or properties are doing, and that would be your responsibility. There will also be legal and regulatory requirements that the local municipality will expect you to have covered, and they will certainly be checking to make sure that you have. And also what can happen, and I've seen this happen, if you are not in compliance with the local laws, this can be an event of default under your loan with the bank, and the bank can enforce and take away the property. So there are these risks, there are these obligations, these responsibilities, which you won't have in a fund, for example. You won't have to worry about all this stuff. Somebody else will be managing all this stuff, and you won't have to think about it. So I raised the example of how difficult it can be to pick a good property manager. A friend of mine, very smart guy, he's a doctor, had a lot of excess income that he wanted to invest in a way that was certainly better than putting it in a savings account. He purchased a number of real estate properties, I think some retail, residential, and commercial properties. Hired a property manager to manage his residential properties. Now things were going well for a while, and then the property manager told him that the property was vacant, and so there wouldn't be any income for a while. But what actually happened was that the property manager effectively stole the property. How did he do this? Well, while he was telling my friend that there was nobody in the property, he actually let the property out to somebody else. He told the tenant that he owned the property, and the property manager had the tenant pay himself, the property manager, the rent. Didn't tell my friend. So he effectively stole all this money and stole my friend's property for 6 months to a year. And then by the time that my friend found out about this, the property manager had fled the country, disappeared, the tenant had vanished, and now my friend was left with a property that was dilapidated and needed repair before he could put it out to let again. And because he wasn't getting any income, he had to pay the mortgage out of his own pocket instead of from the rental income. And there was a period of time where he's not earning any income, and has to get the property repaired. And now this actually brings to mind something else that's important when you own a property. You need to go and visit it. You have to do periodic property visits to make sure it's still there, or still how it's supposed to be. I heard stories about tenants deciding to refurbish the whole property and not tell their landlords. I mean, this kind of stuff goes on. Now, if you're in a passive investment, you don't have to worry about any of this stuff. You've got professionals taking care of this stuff. But when you own the property, as they say, the buck stops here. You're responsible for everything, and if you make a mistake, it can be very, very, very costly for you. Now, that's not to put people off of doing real estate investments, but it's to keep in mind that it's a specialized area and it is far from passive. If you treat your real estate property like it's a passive investment, something bad is going to happen, I assure you. So if this is of interest to you, please keep an eye on it, and make sure that if you don't have the skills today, make sure you generate those skills ideally before you get involved with property investment. Now, why is passive income important to people? Well, it comes down to having a work-life balance. It comes down to spending time with your family. As I mentioned before, my friend is really keen to spend more time with his kids, the most important thing to him. And it's difficult to do that when you work full-time. You see the kids, I guess in some cases, maybe on the weekends, depending on how hard you work. And so if you can generate a passive income, then maybe you can either retire early, or if that's not possible, at least maybe semi-retirement, maybe work 3 days a week instead of 5, and spend more time with your wife, with your kids, and do some fun things, have a sense of freedom. So this is why it's important, but there are many, many challenges in getting to this point where you can have this passive income. It's not easy. If it was, we'd all have it, right? And certainly one of the the challenges that my friend has had is that he focused for a long time on side hustles, generating or attempting to create a part-time business that would generate a passive income. But getting these sorts of things off the ground is very, very difficult. You've undoubtedly at some point come across various internet gurus that would explain that they can help you do this, and many of them can. But it's hard work, it's a lot of work, and it can take many, many years. And it might be that you've got a job that keeps you very busy. You don't have time for a side hustle. So what do? Well, if you're in a position like my friend where you're living within your means and you've got a good amount of excess income being thrown off by your salary, good disposable income, then it makes sense to pick investments that can get you to a point where you can have that passive income. And what is one strategy for doing this? Well, as I've mentioned before, it's really important to get a detailed idea of what the goal is. We know what it is at this point. It's building a portfolio that throws off a passive income. Okay, so how much passive income do you need? Let's say it's to retire, and you want to retire at 55. Let's say that you need $100,000 a year. Now, if we look at real estate investment trusts, REITs, which are diversified investment vehicles typically, and they invest across different asset classes, retail, residential, office, and potentially many other types of properties. Well diversified, they can be diversified across geographical locations, North America, Europe, maybe even global. So there's a good amount of diversification, and REITs typically pay 90% of the return every year as income. So there is that income stream, and you're leaving it to the trust to take care of the management, and you're just receiving the income. So once you know how much you need, as REITs historically on average throw off about 10% per year as return. If you know that you need $100,000 US, you get a 10% return. That means you need a portfolio size of about $1 million. Now, this is all speaking very, very generally. It all depends on your unique situation, and you would have to be clear on what that is. But potentially, once you've built that $1 million portfolio, you may well be in that position where now you can generate the passive income of 100,000. Maybe you can retire. But the approach here needs to be knowing how much passive income you need, being clear and realistic about what kind of return you can earn, and then you know the portfolio size. And then once you know the portfolio size, you simply work backwards to today, wherever you are. If you've got 20 years to run before you're planning to retire, then you simply determine how much you can put away every month, every year, whatever, and at what rate, and if that will get you to your $1 million. So that's basically the approach, and I describe all of this in my book in detail. So it's difficult, obviously, to explain in a few short minutes on a video, but it's well explained in my book. So do go ahead and take a look at the book. Now, I understand that for many people, particularly if you're not an experienced investor, it can be daunting to take that first step. Now, in the previous video, I spoke about emotional roadblocks, and one of those roadblocks was regret aversion. What does a regret aversion mean? It simply means we seek to avoid regret. Nobody wants to feel regrets. And when you're dealing with making a decision about something that is sort of unknown or new to you, investment might be new to you, none of us want to make a bad decision and then have to regret the consequences. Now, this particular roadblock stops people from investing. It stops them from investing at the good times, and it stops them from getting out at the bad times. It's sort of ironic the way this works. But sometimes people will look at a market that's going well and think, well, maybe I'm too late. It's too late to go in. And what happens if the market crashes well after I invest? Or maybe they're waiting for during a crisis. Maybe they're waiting for the market to hit rock bottom, and then they'll jump in and hopefully scoop up some returns. But they'll always be asking themselves, well, is now the bottom of the market? Is now the time to invest? And they'll hold back. And then what happens? Well, the market takes off again, and they miss the bottom, so then they hold back. Now, I think the thing to remember here is that If you look back over time, the market goes up continuously all the time. It's been going up. If we speak about the S&P 500 index, that's been returning 10% on average a year for about as long as it's been around. So we can expect that to carry on unless something happens to North America. We certainly hope that it doesn't. But as long as we assume that human beings will continue to do what human beings do and try to progress and improve their situation, then markets will continue to improve as well. And also, if your goal is long term, then you don't really need to worry about these short-term market fluctuations, whether the market's at the bottom or at the top. It ultimately in the long run, it's not going to make much difference to you. And if it's still difficult at that point, then just take one small step that is so small you can't possibly fail. Maybe just throw in a few $100 to see how they do. But also keep in mind at the same time that the more time that you take to make that initial decision, the less time you have to build your portfolio. So it's really important not to spend too much time trying to figure out what to do, because the decision not to invest or to put off investing is also an investment decision, and it also carries risks. And there's always the risk that if you put it off for too long, you're going to make it that much harder for you to make your goals. So the next video, I will be covering how to choose an active investment. Now, I've spoken quite a bit of time about passive investments. Active investments, it does require a certain amount of expertise and also hard work. So I've spoken about passive investments in this video. So the next video, I'll go into detail over active investments. So thank you very much for watching. I'm Robert Sadler, once again, founder of Nowhere to Invest, and I will see you in the next video. Thank you for watching. As always, please remember to like, share and subscribe to the channel. And if you need more information, then make sure you grab that free ebook. The link is in the description below. Thank you.